All right, we're back here, first recording of 2026. We're all back together. Everyone's settled back into the work life after great holiday season. And that
Only
means
two of us are wearing vests. Sorry.
Brian didn't get a vest for Christmas. He's a little sad about it. But look, man, the best part of the new year, right? Fresh beginnings, and then the always fun kind of state of the market reports start flowing in, right? So we've seen two so far, one from Xywave, Amwins released theirs. I'm sure I'm missing some that are already out there from other people, but you know, I would say on most of the lines of coverage for our clientele, it's more of the same, right? Starting to feel like a broken record year after year. But I think there's there's some other interesting things kind of coming into play now. So let's talk about commercial auto first. What do we see with commercial auto rates? So,
well, I think that,
guys?
it's much of the same as you pointed out. It's that broken record. We're seeing rate fluctuation for the coming term anywhere from 8 to 15%, maybe 20%, for these are still favorable risks. Standard rate adjustments could be worse, for risks that are not favorable in the eyes of the underwriter. And I think even worse is just the further continuation of tightening of underwriting guidelines, where they're not accepting risks, without proven track records, in terms of safety and loss control. So gone are the days of thinking you need to implement telematics or camera. You have to have these things now to be viewed as a favorable risk in the eyes of underwriting. I mean, that's just kind of more of the norm than it's not.
All right, time in. Yeah, on the auto side, I'd say, what we've all experienced is the selective nature of the underwriting now from markets. Like even markets that traditionally would have taken any risk, right, and figured it out, now are almost looking for reasons to decline it, which would say that, the results are bad. That means the underwriters are getting pressure from, their higher ups to write more profitable business. But I think they're still collectively struggling to figure out what really moves the needle, right? Because to your point, Puz, telematics are going to save everybody. You'll get a discount on your insurance. Okay, cool. We're 10 years later. We still have the same losses happening, and arguably they're more expensive. And as much as telematics have helped, they've also probably hurt people with the videos and being able to dial in exactly what was happening and showing a trend that, oh yeah, you were speeding a ton over the last month and you finally had an accident. Shocker, right? So
well,
I would say, telematics isn't, a discount tool. It's a credibility tool, right? I mean, that's the reality. If you don't, you're more credible insured if you have these tools and telematics. And then on top of that, you want to show how they're utilized and how they're effective for your firm, because just to have them these days isn't good enough. Again, underwriters are looking at things with a lot more scrutiny. They are holding to their underwriting guidelines. We're seeing a lot less exceptions being made in terms of, the scary things in their world, I guess, would be, fast growth in a short period of time. Carriers are holding to that now. The experience really matters, and you want to be able to demonstrate experienced driving workforce. Again, you really want to be able to paint the picture to an underwriter these days the best you possibly can. And, again, if you've got some fluke accidents, they'll still, look at those, objectively, I think, as long as you can display, a good picture across the board elsewhere.
Yeah, I think the name of the game there, Brian, to reinforce what you just said, is the follow through, right? We've seen telematics in the marketplace. We've seen the four-way cameras in the marketplace, but it always comes down to the if then what, where we're dealing with, you hear it all the time, driver labor shortage, right? This individual is my best driver. Yes, he made an error here, but we can't get rid of him, and that's where you start to see, the technology snake bite you, because it's that one time where you make that exception to the rule, your published rules for termination or whatever the case may be, and there's a claim, that's where you're being hung by a jury of your peers. So that's where the type of products that are out there, they're needed to be had, right? But the reinforcement of them, putting them in place and actually utilizing the way they're meant to be used is more important than actually having them to begin with.
Yeah, do you think there's a disconnect? Like, the insurance space is, for the most part, I think, very reactive, right? We try to be proactive in underwriting, but the whole mechanism is reactive. Loss happens, claim happens, insurance takes care of it, right? I think that there's a disconnect from the consumer, from the buyer, the transportation company, of they're being reactive a lot of times with drivers and what they're seeing instead of being proactive, right? And I think that's what that piece of things, to be able to go and say to an underwriter, look, we proactively got rid of these drivers because we know the way they're trending, they were going to cause us a loss, would carry a ton of weight versus now we have to terminate drivers because they don't meet the criteria when we go to underwriting, right? Those are the little things that would probably make a big difference. I think it's just a different mindset, and it's hard to get people's minds wrapped around that as we continue to move forward and the results continue to drive the pricing up. And by the way, you can do all those things and you're still going to get an 8% increase potentially, right? So
how much have you seen it on the underwriting side where driver reporting is now required monthly, right? So obviously it's on the radar, for the carriers to say, hey, we want to know about your new hires too during the course of the term. We're not going to just check this on an annual basis. So people are understanding that the more that they're on top of the driver behavior, the better, chances of risk mitigation, right?
Yeah, and this goes to both fleet, auto liability, right, and hired and not owned, because the more we move forward and we see the claims, and we all see them, the frequency and the severity on the hired and not owned front, which is part of the reason why you've seen markets pull back, right? We had a couple years there where a bunch of markets dove into hired and not owned auto, and now they've all pulled back either their capacity or even wanting to write anything. I think probably just they misunderstood what was really going on in the final mile space with hired and not owned. But you're seeing the claims driving those costs up still on the premium on the hired and not owned, right? It's moving more or less towards being fleet auto liability that it's moving away from it. Yeah, that's going to continue.
Yeah, I mean, you're what, 13 years running of no underwriting profit on the commercial auto side, right? And ultimately, you're talked earlier about how you've got carriers that aren't offering terms to risks that they may have done 2 or 3 years ago. You've got major players like a Progressive not underwriting this type of risk in the state of California, an entire state. They're not doing new DOTs anymore, something that you used to be able to go to when you had a risk like this. You can't. So that just tells you that the market continues to tighten. So the people that can produce themselves in the best light, the best capacity in the eyes of the underwriter are going to be the ones that are viewed the most favorable, moving to the top of the list, right?
Yep.
I mean, and in terms of the non-owned and hired side, it's like, to your point, yeah, it is a problem. It is becoming more primary. The newer markets that have gotten into play there really took a bite of the apple that they didn't understand. They were writing forms that really weren't written, for this class of business. And then you've seen, just as we've said, a pullback on the offering. You've seen a pullback on the capacity. You've seen a pullback, just on the general offerings altogether, and that's going to drive people back to where they were at a higher rate. So if they were, promised, cheaper rates and cheaper premiums and they got it for a year or two, now they got to go back, to something that's 30, 40% materially different. That's not going to help in terms of their customer relations either.
No, the answer is not to just shotgun your submissions out to different markets and just hope for the best each year. That's just a terrible way to play it, unfortunately. If you wanted to do it every couple of years, that's fine. But like you said, there's a lot of market constricted or retraction, I guess, is with the availability and again, the forums that are out there are just not as broad in coverage in the normal sense that that the industry has been used to over the years. So, again, to your point, I mean, it's just few and fewer options out there, you're better off figuring out, again, how to paint that picture, right? How to work with your brokers and, develop the proper safety and loss control culture, to develop, the retention of drivers culture, right? That they want to have and display that they've been working for you for a while, utilizing telematics effectively, using analytics. How can you, especially if you're in the own fleet realm, right? How can you use analytics effectively to control your exposure? What trends are you seeing from the analytics? Are you seeing backing incidences in certain locations or, geographically, right? So then you take the safety and loss control and address that accordingly. And then you tell that story, which then helps with the underwriting story by corrective actions that have taken place. So.
Yeah. Well, and I don't think it'd be a surprise to anybody listening, right? Everything we just said about auto, just copy paste over to what's going on with the umbrella market, right? Prices up, rates up, losses still continue. Everyone's pricing is going up. Underwriting restrictions are harder. So it's a compounding effect if you have an umbrella on top of, a commercial auto premium that's pretty sizable, right? So.
Yeah, I mean, the umbrella market has been a challenge for a number of years. We've seen, at least on the rate side, where I would say 3 or 4 years ago, we finally started to see that to follow suit on the auto with rate adjustments. And then you started to see underwriting be just as intense as commercial auto underwriting is. And it used to be, you'd give the underwriter your underlying quotes and they would have a target. Okay, we got to be at about 20% for the first million tier. Okay, what's your underlying price? Here you go. Then it was a couple years later, it was 25. Then it was 30. Now it's like, we don't do that anymore. Send us your quotes. We take it, but we want all the underwriting information, and we're going to develop our own quote for the umbrella. We're not really trusting what the primary market and how they rate it. We want to rate the umbrella the way we see fit. That's changed a tremendous amount in terms of the underwriting side. And now what you're seeing is just the overall constriction in terms of offering. You can't, very difficult to get a $5 million umbrella placement from the same paper. Usually something that kind of limits requiring you to get 2 to 3 different players involved. And that's a big change from what we've seen in the past 5 years as well.
Yeah, and even the timing is more challenging, right? I mean, we've always had the ongoing challenge of timely quotes in our space because of the underwriting nature and last minute nature of the industry. But, years ago, it was a lot faster to get an excess and an umbrella quote. 2-3 days tops maybe. And now that's just, further extended to, a lot longer because of the underwriting nature that's going on in that space. And again, I think we're starting to see, again, less options available, very little reinsurance players entertaining the space. We've seen a little bit of creativity happening, recently on larger excess opportunities in terms of, 3-year aggregated deals, and but that's for larger opportunities that are willing to take on a little bit more risk. And again, aggregated deals obviously is not as much coverage as a per occurrence arrangement that the industry has been used to. So yeah, it's just kind of following suit. Still not a lot of positive news on either front.
Yeah. No, and I think that, we hit pretty hard. We talk about the auto, we hit pretty hard the underwriting side, but what outside influences, are causing a problem on both the auto and the umbrella, right? You want to talk about, you always hear the buzzword of nuclear verdicts, right? And you Google that and you can read all the horror stories. I like to talk more about the settlement creep than I do the nuclear verdicts, right? Because I don't think anybody pays attention to the fact that, they're the frequency of claims and where they're at, and the higher per dollar average of settlement that you've seen. That's what's really burying the insurance companies. It's the thousands of claims that are settling materially higher than they historically have been, and that's being driven by what? Inflation in the market, higher medical costs, higher product or replacement costs for automobiles, right?
Yeah, your frequencies becoming a huge issue. I mean, your loss ratio may not actually be that bad in terms of, losses paid versus premiums paid. But then you look at that the frequency ratio where you have a fleet of 50 vehicles, but you've had 20 claims. That's a problem. And that's going to be scrutinized just the same.
Yep. Well, and that sets up those trends. Then when you finally have a big one is where you get absolutely destroyed with social inflation then when it hits the desk of plaintiff's counsel. And then to your point about settlement creep, right? You've got attorneys that are trying to get these things settled for the smallest amount of dollars possible. And the risk is if we go in too low, we turn this into a long, prolonged battle and maybe it goes to court. So we've got to pick a number that's juicy enough to entice everybody to put it to bed and move away. That's still less than if we lose it in court, which is crazy. But
that's a dangerous game because, if you do go to court, you hear the buzzword there too about third-party litigation funding, where you've got companies that are funding law firms to try to stretch out claims for a higher verdict to participate in settlement. Think about that. Right?
Who do you think has the better law firm representing them?
Yeah, right.
Yeah.
So it's like there was specifically in that Zyway article, there was a statistic about an increase of advertising in the litigation space, up like 39% or something like that, $2.5 billion spent just targeting, claimants in the commercial auto segment.
How many Tim Misney billboards have you seen around Cleveland?
You want me to give me my best impression?
I'll make them pay.
Oh gosh, awesome.
So the other part that we've seen, at least recently with creativity, has been on the cargo front too, I think, as we've seen the trick or device, fraud or deceit, whatever you want to call it, right? As those claims have gone up and you still have high theft items now with black market value, we're seeing changes in those forms. Not so much rate change, I don't think, at least not what I've seen. Maybe you guys have seen differently, but more of a coverage form change coming for most people. Would you guys agree with that or disagree?
Yeah, I mean, that's something that's a long time coming, right? Because ultimately we've been seeing those types of, trick and deceit or fraudulent type claims in the marketplace for a number of years. Cargo forms have been particularly silent on the exposure and have gotten buried in a large capacity. Now what you're seeing essentially is forms come to market where they're either excluding it or they're sub-limiting it down from the primary cargo limit. So insurers need to be aware, what that means. That means, effectively, if you're tricked into giving freight to the wrong motor carrier, somebody that deceived you into giving it to them, you might not have coverage for that type of loss, or you might not have the amount of coverage you thought you had for that type of loss. And those are the questions you need to be asking your insurance partner as it relates to that kind of exposure, because it's a growing problem in the industry. I mean, I just saw a live example last week where I had an insured that's a freight broker. Someone lifted his FMCSA login information, apparently changed his safer profile to show that he, transports vehicles, produced a fraudulent certificate same day to a dealership, picked up a Ferrari and disappeared with it.
That's unbelievable.
So, it's a situation where that's what you're dealing with in terms of the cyber criminals targeting this class of business. It's a highly transactional industry, and so something like that can happen very quickly where people just aren't paying attention well enough, and before you know it, you've been hacked, and so in that kind of situation, if you don't ask the right questions on your insurance policy, you might not have the right coverage.
Yep. Yeah. All right, let's talk about everybody's favorite buzzword, AI, and how it's going to save all of us a ton of work, and it's going to be the greatest thing that revolutionizes all of these industries. Look, we all use it. No disrespect to it. It's a great tool, but it's causing some problems on the insurance side of it, right? We're seeing claims that are coming through because anytime you have people start relying on something quickly and not really monitoring it, of course, the criminal enterprises of the world glom onto that. So we just had a nice little internal security deal we had to watch where it was talking about embedding code in emails so that if you are automatically using something like Copilot, right, within Outlook, it reads it, it sees the code that you can't see, and it performs an action that you really wouldn't want it to perform, right? And so that's just one example of it, but we've got plenty of them. And what it, let's talk a little bit about AI and the shortcomings.
Well, I think, the biggest thing that is, as the usage of AI goes, is going to be some oversight. Company policies put in place in terms of how employees are using it and for what purpose. We've seen, claims examples where people are utilizing it to, write job descriptions, for hires that they're looking to make in the market. It's turning to EPLI claims, for discrimination in terms of what they're looking for, because nobody was actually vetting, the content that was being published. They're just using this tool quickly. Seeing some, some examples that were in that Xywave article was general just representation of the company's services, potential for a D&O type claim, because AI was making it seem like it was a little bit more doing more than what their offerings really were. Again, it's a tool that's great, in terms of being able to utilize and get things done quickly, and it sounds more professionally, but at the end of the day, there needs to be more oversight, right? More guidelines put in place. If employees are going to use, this type of thing, probably needs to be done within certain parameters.
Yeah, unfortunately, it's not right all the time, right? That's the reality. And again, I think, our generation and older generations will question it. That's, if you're not too familiar with something, you need to question it. One way to question is utilizing multiple AI sources. But, I'll give you an example, just kind of unrelated to insurance. My son and I were just messing around on ChatGPT, and we asked, who the Cleveland Browns should hire as their next head coach. Well, it said Mike Vrabel. And Mike Vrabel is the current coach of the New England Patriots. So it's not up to date on a lot of things. So
he'd be a great coach, by the way.
It was
fantastic.
He was an assistant coach for us last year, by the way.
What agreed. I would have totally done that. But to the point is, it's not always right. So you really have to cross-check the information that's being, and I feel like, unfortunately, the generation that's coming behind us is going to take it as gospel. So, and then you also have political bias built within those platforms, unfortunately. So you have to check that.
Well, I think, like one of the greatest things I've seen from Brown & Brown is just published guidelines in terms of terminology, when speaking to clients or publishing things in the marketing capacity, because they have verbiage that they want utilized, and so taking that information and being sensitive to the utilization of ChatGPT, dumping it in there, to teach the bot, hey, this is what we're looking for when we're publishing, something back or reciprocating information back, this type of content, this type of verbiage. I think that just further speaks to what's going to be needed. If employees are going to be using this technology, some type of corporate governance is going to be needed for it.
Like
so is there
everything.
anything that was favorable, any favorable classes of business or lines of business in that Xywave article? I know that workers' comp, right? That seemed to be favorable in terms of, the still kind of the golden child in terms of performance, right?
Yep. Workers' comp is probably the lone bright spot, it would seem. So, that's great. If you're an asset-based and W-2 based, operator, you're going to love it. But and even that, as it would stand to reason, right? That probably doesn't hang on that long. We always see workers' comp cycle, and some of that is just the nature of the benefits costs. So, you get injured on the job, there's still medical that's got to get paid. Those costs aren't ever going down, right? They go one direction in this country, up. So you may see a momentary, I would be cautiously optimistic you would see a year-over-year reduction on the comp side.
Well, I think what they have on the workers' comp side is still headwinds from COVID, right? The labor force has been at home as opposed to in the office. And so you've seen just the claims drop more favorable in the insurance companies, eyes. And so that's changing, right? Then people are getting, more return to work, more outside of the home. That's going to start bringing it in the other direction. And to your point, I think that article even stated, medical costs in the U.S. next year are predicted to go up by 9.2%. So rising medical costs and then an aging workforce as we see it, is going to cause problems eventually when it comes to that coverage line. But for now, it's in a good spot.
All right. So 2026, lots of positive, good news to make you feel good about where your insurance costs are going. But in all seriousness, like there are some ways to counteract what's going on, and we'd be happy to talk with you about it. We obviously wish everyone a very successful 2026, and we look forward to seeing folks at the various industry events and, hopefully a little more in-person stuff this year. So have a great year, everybody, and we'll reconnect with you sometime here in the near future.
Sounds good.
And done.
Yeah.